Hey everyone, this is Craig, the options linebacker. This is the weekend report for Sunday, December 5th. We'll start out here with the Dow Jones Industrials on the left-hand side, the transports on the right. The reason why we pair these two together is they form the components of Dow theory. The thinking being that if the industrials produce a product, the transports ship it, and if they're both heading in the same direction, that tells you something about the market. In this case, right now they're both heading up. The transports are a little bit ahead of the industrials. The industrials have not yet taken out the early November high yet, but it seems to be just a matter of time. However, if it does not take that high out, then what we have potentially setting up is a range that the Dow is going to trade within. Now, something that I've noticed for about the last week or so is this whole pattern here, this whole corrective pattern that happened over the summer, and then this most recent corrective pattern. This is a cup with handle pattern. The target on this for the Dow would be somewhere around 13,000 sometime in the year 2011. And the target for this is really the depth of the cup. Now, I'm not here to judge whether or not that could actually happen or not. All I'm here to do is to look at this pattern and say, well, it certainly could happen. So what we don't want to do is to find ourselves 6 months from now with a Dow at 13,000 and say, well, gee, but I didn't think it could work. It's not really our job to determine why or if something could happen. It's just to trade what we see and not necessarily what we think, and certainly not what we read in the news. Now, as we look at the growth indices that we have here, the NASDAQ and the Russell 2000 on the right-hand side, same deal, higher highs and higher lows. Very shallow pullbacks on here. We'll get to that in a minute. And right now, actually, the Russell is leading the entire market higher. Let's take a deeper look into the Russell, starting with the monthly chart. Here's a monthly chart of the Russell going back about 15 years. And notice how it really, from a larger than a monthly time perspective, has never really broken trend, believe it or not. Now, we certainly did, from a monthly perspective, have a change in polarity to a downtrend here. During the bear market, we had lower lows and lower highs, but that's recently been reversed. We do have a change in polarity now to an uptrend with higher highs and higher lows. Notice also that the Russell is only about 100 points away from hitting its all-time highs. And I would say that what we've seen here in the past year and a half is anything but a bearish chart. It doesn't matter what I think or what's happening out there in the economic world. This is an extraordinarily bullish chart. Find a time at any time during the Russell's history where we've had so many gains coming up off the bottom of this with higher highs and higher lows. This chart has been leading the market higher since March of 2009. What makes this extraordinary to me is that these are 2000 normally fairly illiquid stocks. These are not GE or JP Morgan or Chase Bank or anything like that. These are illiquid stocks that if you buy these in quantity, they will move the market underneath you. This is a very risky proposition for fund managers to get into stocks like this, because if they're, as we've seen here, if they're on the wrong end of the trade, it's very, very difficult for them to liquidate their portfolio of these stocks. So it's extraordinarily significant that we're seeing them pile into these stocks right now, so close to an all-time high, because right now what they're doing is they're chasing performance. Now let's go down a time frame to the weekly chart on the Russell, and we can see that, let's not get too excited here because we may have a little bit of overhead resistance here at right around 760. This may be some overhead supply that we may run into on the Russell, because it tried to get above that level back in 2008 3 times and could not do it. So we'll see whether or not it gets through on the first time here in 2010. As we get down to the daily chart on the Russell, one thing it's fighting right now is the fact that it has come so far so fast and is now presently above the Bollinger Bands. Normally when we see something like this, it signals that it has come too far too fast and it's ahead of the market, and it needs to slow down, allow the bands to expand to catch up to it, and allow the market to catch up and find new buyers. But the number one leading indicator in the market right now out there is the dollar index. So it's $DXY. And you can see that just since we had this move here in early September, where the dollar just got crushed, what happened to the stock market? It went straight up, right? What's happened here since early November, where the dollar has rallied, the stock market has gone straight down. And what happened over the past 3 days? Stock market went straight up. So it's mirroring the stock market, what's happening here. So watch the dollar index, because as the dollar goes, so will the market. Now let's spend a couple of minutes on my favorite chart, the S&P 500. The S&P 500 since November has gone through a corrective period here, and the thing that I found interesting was that it was a wave-based correction. So in other words, it formed a lower high and then finally came down and double bottomed here. And what that means to me is that this is a weekly time frame move. It's not just a daily move. A daily move is something where we saw just, quick pullbacks here, or here's a daily move, here's another daily move, like that. These are weekly moves, ones where we have a wave-based structure to it. Even this one had a little bit of a wave-based structure to them, and they were all about 80 points, roughly, give or take about 80 points. This one only got down to about 54 though. So I was expecting a more severe undercut down to maybe 1155 or so on the S&P. Never got it. We got bearish enough conditions, and we just got enough of a positive lift last week to get this thing launched and tack on 50 points in no time at all. Now the fact that it was only 54 points comes with some good news and some bad news. The good news is that things were bullish enough to be able to get off the ground right now. But to get these 180 point Mongo moves here like this, what it requires is that the market gets extremely negative. If you recall, at the end of August, things were about as black as they've ever been. The sentiment was certainly as dark as it was back in the fall of 2008. It was terrible. I couldn't even stand to read a newspaper. It was so bad. And look at the move that we've gotten off of it. All it takes is one little piece of good news, and the market is off and running, just like you lit some tinder with a match. Notice that it took a good 80-point move. It took lower lows and lower highs. You had to get people really, really bearish to start shorting there. And then what happens is, as they're proved wrong, they're covering all the way up here, screaming. And the very last ones covered up here. So my concern is that things never really got that bearish last week as we probed down to 1173 on here. Consequently, what this means is that we won't get that much of a move out of here. Perhaps we'll get up to 1250, 1260, something like that. But I think we're still eventually going to have to come down from a weekly standpoint and probe down to this level again to really get things worked up. That's how markets work. Sometimes you have to take a couple steps back to take 3 steps forward. Now let's talk about our positions for a minute. For the December cycle, I'm already out of most of my positions. That as we got this bounce up here, we got it to the level where it just didn't make sense to hold anymore for the next 2 weeks until this green expiration line to just get a few more cents of profit. Now we do have a couple of butterflies that are up here. These were defensive trades, but they're just not worth shutting down right now, so I'll just leave them in case we do get a move that wanders into one of them. They can be very profitable if the price just happens to wander into it. Then for the January cycle, we have the full iron condor in play right now. We're sitting up at the 130 level on the spiders, as well as the 104 level down here, or 1040 in the S&P. So this one is long gone. And within 5 days of trading, this thing is already about 60 to 70% profitable. We'll probably look to take this one off fairly shortly. So that's it for this weekend. Hope you guys have a tremendous week in trading, and we'll see you next weekend. Take care.